Everyone talks about the magic of SIP and investing in the long term, but what if you need to go for a vacation in 8 months and not 8 years? Or what if you want to buy a car in the next few months itself, or purchase a house 2 years later, or even save for higher education or your wedding? Where should you invest for all these short-term goals? Today, I'm going to share with you 7 investing ideas for your short-term goals that could be anywhere between 0 to 4 years, and also 2 places you should never ever think about investing. This also includes, by the way, a new type of mutual fund in India that has become popular in the past 1 year. So let's get right into it with the exact playbook that I share with my clients. First up, before you even decide where to invest, you need to figure out how much you need to invest every month to meet that goal that you have. So here's a simple calculator that I have created, which you can get access to for free using the link in the description. So the first thing that you need to do in it is enter the amount that is required for your goal. So let's say you want to save for the down payment of a car, could really be anything, but let's just take this as an example. So let's say you need 5 lakh rupees, right, for the down payment of your car. Now this, remember, is as per today's money. So don't account for inflation right now, because the sheet actually does that as we go along. And let's say you need this now 3 years later. The inflation rate, which assume is the rate at which car prices are going, is 7%. You can change this, let's say, to 8%. Now if you see, right, you no longer need 5 lakhs, you need 6.29 lakhs. That 1.3 lakh additional has just been the factor of inflation, so it's important to consider that. Now, if you're investing for 3 years, as we go along, you will realize where we'll invest. So the typical return that you have seen is about 9 to 10%. So we'll assume 9%. The moment you do that, you will realize how much you need to invest for that every single month. So that's 15,191 if you are starting from 0. But let's say you already have 1 lakh rupees, right? So I'll just put in 1 lakh. The moment you do that, you will realize that the monthly investment needed to hit your goal starts going down. And you can again customize it as per your needs. But now it's important to remember that you need to invest 12,068 rupees per month to be able to get to your goal of 5 lakhs 3 years later. Now the big question is where to invest. Now I'm going to break it down as per a timeline. The first one is for goals that are between 3 and 4 years away. These are those in between goals because they are neither too short term, but they are not also very long term either, right? Now here's where most people make their first big mistake and destroy their money and short-term goals. They think I'll just put it in the stock market and that will just make it grow faster. But that is extremely risky, because over shorter periods of time, the stock market can even give negative returns. In fact, data over the last 25 years, if you look at it, the Sensex has delivered under 8% annualized returns 30% of the time, right, across any 3-year period. And 7% of the total time, you would have actually gotten negative returns. So you would have actually lost money. Now here's the fundamental rule that you have to remember across this entire video. The shorter your investment horizon, the lower amount you need to invest in the stock market. For goals over 7 years, which we are not covering today, you can potentially invest 75 to 80% of your money either directly in stocks or through equity mutual funds. But as your timeline shrinks, your stock exposure should shrink too, and you should just add more safer assets like bonds to your portfolio. So having said all of that, the 2 options that are available to you for goals that are 3 to 4 years away are, first up, equity savings funds. In such funds, only 33% of your money gets invested in the stock market, and the rest in safer assets like bonds and arbitrage opportunities. In fact, in this type of fund, it's exactly split 33 or something very similar. Now, what are exactly arbitrage opportunities, right? Think of it as a fund manager who can spot price differences in 2 markets. So if the same stock is, let's say, trading at 100 rupees in the cash market and 101 rupees in the futures market, then they essentially buy at 100 and sell at 101 simultaneously. And because they can identify the price gap and only then do they enter, this is like risk-free money. Now here's the clever part. Because this type of a fund technically deals in stocks through arbitrage opportunities, it gets the benefit of equity taxation. So you get bond-like safety and stock-like tax efficiency. I'll get into the exact tax specifics in just a bit. Now such funds have delivered between 9 to 10% annual returns over a 3-year rolling basis over the past 10 years. And in this space, equity savings funds from ICICI Prudential, Kotak, SBI and HDFC are the biggest ones. Now let's have a look at three specific equity saving funds, HDFC, Kotak and SBI, and see how they would have done over a 3-year period, right? So if you notice, only during the very depth of the pandemic crash, right, the very bottom of the pandemic crash, did they actually give negative returns. Kotak in that situation, as you can see, even then was positive 2.2%, but over a 3-year rolling period, right, the median return is about 10.2 for HDFC and about 9.2, 9.3 for Kotak and SBI. So that is the rate that we assumed as well, right, 9% when we are looking at the calculator. So keep that in mind as you potentially invest in equity saving funds, because you don't want to invest in these thinking that, oh, I'll get 20% returns in 1 year. Now, that is not impossible, but the stock market will have to do remarkably well for that to happen, right? If you notice here, it has never ever happened in the past. So it's important to temper expectations between 8 to 10% returns. That's what you should sort of calculate when you're looking at equity savings funds. If you want to apply what I share here on YouTube to your own life and investing, check out my program, The Complete Guide to Mutual Fund Investing. It has all my years of experience of being licensed in Indian financial services since 2015. In it, I've covered topics like how you can select mutual funds to invest in, how to build your mutual fund portfolio, a much deeper dive than this particular video, what is an SWP and how to plan for your various goals, among other topics as well. The guide also has Excel tools like this one, where you just enter the goal that you have, the money that you require for it, and it automatically tells you, factoring in inflation, how much you need to invest per month from now onwards and which mutual funds to go for to save for that goal. Once you sign up for the guide, you'll also be part of our monthly live Q&A sessions where I answer all your doubts. To check out the program, go to the first link in the description and the pinned comment. Then option number 2 is balance funds. These typically invest between 50 to 65% of their money in stocks and the rest in bonds. So they don't have any arbitrage opportunities in them. Now, as you can imagine, the moment you start investing in these funds, because they have a higher allocation to stocks, the potential risk of investing in them also goes up, and the chances of you getting negative returns technically increases. But that also means that if the markets do well, because you have higher exposure to stocks, your investment portfolio would tend to do better. Let's look at the two biggest balance funds that are there in India, amongst the oldest ones as well. One from HDFC, one from ICICI Prudential, and we look at the category average as well. So here you notice, right, I'll say select lump sum investment to begin with. Let's look at 3-year rolling returns from 2006 onwards, right? Look at this. This data starts from December 2006. So it's very old, has been through multiple market crashes. So if I just highlight HDFC's fund here, you would notice the two occasions where it gave negative returns across a 3-year period wasn't 2008. It is actually late 2013, somewhere around here, right? And then in the COVID crash. And if you notice, the quantum of the fall during these two instances is actually higher than that you saw in the equity savings fund. And that is understandable, right? Because these by fundamental nature have higher money invested in stocks. Let's look at 3-year median rolling returns, and there you will see again, because they have higher exposure to stocks, they just have simply higher 3-year rolling returns as well. And again, important to keep this in mind, because every investment has both sides, right? One of higher returns and the other of potentially higher risk as well. What determines both these factors is essentially how much stocks do they own. And as you can see, the higher the stocks, the higher the risk, but higher the returns as well. So if you're okay with handling that volatility, if you are in a position where, let's say, you are 50,000 short of that goal or 1 lakh short of that goal, but let's say you have a strong income and you can fund that, cover for it, then nothing like it. This could be an option, especially if you're an experienced investor. But if you're not an experienced investor, you are kind of unsure of how to go about all of these things, then essentially just blindly go for equity savings funds. Again, remember that also carries risk because it has that 33% exposure to stocks, so it doesn't make it risk-free, but it's comparatively lower than, say, a Nifty 50 index fund or any other equity-oriented, pure equity fund. In both these options, equity savings funds and balance funds, the taxation is the same. If you hold these funds for more than 1 year, you get long-term capital gains taxation, which means that the first 1.25 lakhs of profit every single year is tax-free. And once your profit goes beyond 1.25 lakhs, on whatever the excess amount, you'd pay 12.5% in long-term capital gains tax. Now, if you hold your investment for less than 1 year, that entire profit that you make, right, that entire profit is taxed at 20% as short-term capital gains tax. Now, let's move on to goals that are between 2 to 3 years away. And this is where the new category of mutual funds has come in, which has become popular. It's called income plus arbitrage funds. This category has become popular because of changes in taxation rules. Now, back in April 2003, these changes happened, and that just meant that all bond funds, whatever gain that you make in them, would be taxed at your income tax level, which meant if you were in the 30% tax bracket, then essentially whatever gains you make, your tax liability would have been 30%. Now, what income plus arbitrage funds do very cleverly is that they invest about 60 to 65% of their money in bonds and the rest in arbitrage opportunities. Now, if you remember, arbitrage funds or opportunities, they are taxed like equity funds. So, because of this clever usage of both these assets, these funds enjoy the stability of bonds because arbitrage funds do behave like bonds in terms of their stability. But because they have over 1/3 of their money invested in arbitrage opportunities, which are taxed like stocks, they get the tax advantage as well. So these funds, if you hold them for more than 2 years, then you're again taxed 12.5% and you still enjoy 1.25 lakhs of tax-free gain every year. Anything above that is at 12.5%. Now, the moment this taxation rule changed, a lot of fund houses came in and became creative to start this new category of income plus arbitrage. So I won't look at long-term returns because a lot of different types of funds were recategorized or restructured as income plus arbitrage. But in the past year, these funds have given between 8 to 9% returns. Even if I assume 8.5% returns and still assume 12.5% taxes, the post-tax return is about 7.4%. In a bond fund or an FD giving 8% returns, that drops to 5.6% post-taxes if you are in the 30% tax bracket. And we'll explore more on these comparisons on post-tax returns in this sheet that I have that I will share with you in just a bit, and we'll actually go through it together. Then for goals under 2 years, you need maximum safety and liquidity. And in that case, I have 4 options for you, and for each, I will share with you the exact Excel sheet and we'll go through it step by step. First up are good old fixed deposits. They are safe, right? And you exactly know how much return you're going to get. There is no chance of that deviating. Now, in the current situation, FD rates have dropped than where they were a year ago. So, HDFC Bank's FD rates, for example, for an 18-month FD is at about 6.35% annual interest. You could also invest the same amount in the name of a senior citizen in your family and or set it up at a small finance bank and get a higher rate of interest that is typically 1 to 1.5% higher in total. But honestly, I'm not a huge fan of trying to over-optimize for small amounts and open different bank accounts just to get that higher interest. The difference because of that higher interest is negligible. In fact, just to give you an idea, let's go back to my goal planning amount calculator. And again, let's have the same amount required, but now in 2 years. Here, remember, you need to invest 17,600 rupees at a 9% return. But if I change this to even 7%, right? The difference is not that much. It's only 1 extra 1,000 that I have to invest. And believe me, the kind of hassle that you have to go through just to get that 1% extra interest in an FD is completely not worth it. And if I make the difference 1%, it's going to hardly be any different, right? So the idea is don't over optimize, especially for short-term goals. Your rate of return does not really matter. Your rate of return does matter over long investment periods, right? Because that's when it really starts to make a big difference. Now, at the same time, you could also start a recurring deposit, an RD, so you can save this amount every month. But there are 2 big issues with FDs and RDs. Firstly, the entire FD or RD interest is taxed as per your income tax slab. So if you're in the 30% tax bracket, right? So let's assume you're getting 6.5% returns and interest on your FD and you're in the 30% tax bracket, your post-tax return is only 4.55%. Now here, this sheet again is available for you, with you in the description for free. You enter how much amount you're investing, enter your tax bracket. Also just check if you have sold long-term equity funds over 1.25 lakhs in the past 1 year, so that, we can start comparing them across these categories. They're blurred out right now, but we will unblur them as we go along. So look at the massive impact of the tax right here. 2% lower is what you get. So that's why I'm not a big fan of these. Plus, they're illiquid by nature. Some new age platforms do offer now ways to break an FD without any penalties, those are good to explore, but the tax problem still stays. There's one more option here that people like to explore, and that is of high interest savings accounts. Typically, you can get about 6.5 to 7.5% interest here on a savings account. So A, it's very liquid, and B, that money is just there growing at a very high rate, right? But again, the problem is, one is practicality, because typically for these very high interest savings account, banks require very high deposits of multiple tens of lakhs, if not crores, right? So remember that may not be viable. And secondly, once again, income tax will still be applicable. So you'll still pay tax at that higher level. If you're in the 30% tax bracket, you will still pay tax at the 30% level on the interest that you've accumulated here. Now, instead of any of these, I would consider the next two options very seriously. The next major contender is arbitrage funds. I told you what arbitrage funds earlier are, right? They just look at price differences in two markets, play on that difference. So in this case, in arbitrage funds, 100% of your money gets invested in such arbitrage opportunities. Arbitrage funds have never given negative returns over a 1-year period, and their average 1-year rolling return in the past 10 years is about 6.6%. So let's go back to our sheet here. Let's say the average return has been 6.5%. Now, in this case, the post-tax return is basically 6.51, the same, because the tax post 1 year is 0. But let's say you've sold long-term equity, right? Let's say you've sold some other investment, then yes, there will be tax applicable, and that drops to now 5.7%. But if you compare that against a fixed deposit, it is still higher. So remember that. There are two more opportunities here that we would want to explore, and I'll get to that in just a bit. And finally, we have short-term debt funds. This is a type of a mutual fund that invests in a host of bonds. I'm going to show you the portfolio of the ICICI Prudential Short-Term Debt Fund, one of the biggest, oldest debt funds in India. If I go to portfolio, you would see, this has 198 bonds in it. And if I go down to the portfolio, you'll see a bunch of different types of bonds, right? There's a Government of India bond, which holds 5.2% of this entire fund's money. There's LIC Housing Finance, and so on and so forth. Now, such bond funds are very safe. Typically, you would want to stick to fund houses with very large AUMs, with good credibility, good track record when you're investing in bond funds. Now, in the past 1 year, the average short-term debt fund in India has given 8.4% returns. But again, that is taxed at your income tax level, which in this case is 30%. And by the way, we'll just change it to a different amount and see how it changes as well, right? But because of that, what tends to happen is that your post-tax return significantly drops, just like an FD. But even then, because there's a big differential between what the FD rate is and what the short-term debt fund rate is, you'll still get higher returns, or would have gotten higher returns in the past 1 year in a short-term debt fund. Short-term debt funds, the other advantage they offer is that they're very liquid. So if you invest today, want to redeem that money 3 days later, 3 months later, 1 year later, there is no fixed tenure for which you have to stay invested like an FD. That's why as well, they just are winners for me compared to FDs. Let's change this income tax rate to, let's say, 20%. In that case, again, right, you will see how the different returns pan out. The winner though, right, if you're investing for 2+ years, is essentially this category, income plus arbitrage. In the past 1 year, they have generated about 8.5% returns. Remember, you have sold equity of more than 1.25 lakhs. So whatever profit is made is taxed at 12.5%. And then, right, you still get a return of 7.44%. And that's why this becomes the where to invest option. But remember, this, even though this subsheet here says after 1 year, this favorable taxation for income plus arbitrage funds only kicks in after 2 years. So remember that. And if you have an SIP in these funds, then potentially some part of that SIP contribution will still be 1 year old. So remember that will still be taxed at a different level, which is your income tax level, whereas the investment that is now more than 2 years old, as the installments keep getting older and older, they would be taxed at 12.5%. I've got a similar sheet here for before 1 year. So if your investment horizon is less than 1 year, and I think you can again just enter the values here. In this case, you would notice with a similar kind of an annual return over the past 1 year, you would notice that your fixed deposit, short-term debt fund, out of all of these, even then, income plus arbitrage wins, short-term debt funds are a close second. and then you have arbitrage funds as well. But FDs again fall behind the pack here too. In the short-term debt fund category, funds from HDFC and the ICICI one that we saw are the biggest ones and the oldest ones in the category. So those could be worth considering purely basis those factors. Alright, now the two places that you should absolutely always avoid for your short-term money. The first is any type of pure equity investment. It could be through mutual funds or investing directly in stocks. Now, let's say you're tempted to invest in these places. Yes, they do have the potential to grow your money even in the short term if the markets do well. But there's always a chance that it may not work out, right? Because the markets have not done well and then you just have significantly lower money than what you need for that pressing goal that you have. The second place you should absolutely avoid investing for any kind of a goal, no matter short term, long term, are P2P loans or P2P lending. These are very risky and they offer between 8 to 12, even 15% returns depending on the platform and where you're investing. But there is always the chance that you would lose your principal, right? The amount that you've invested, because it's actually very risky. There have been instances in the past couple of years where P2P platforms have actually stopped people from redeeming their own money, right? So that's how bad it can get. So just imagine your money getting stuck, not able to withdraw it, and it just becomes a whole big mess. So always avoid them. And now to round it all up, remember to always prioritize safety when it comes to short-term investment goals. Because as we saw, 2 to 3 extra % returns or even 5% extra returns it's not really going to make a difference. So why do you want to risk your hard-earned money when all these other options are available? If you enjoyed this video, then check this one out where I talk about the #1 wealth killer in Indian households. What is it? Check it out and I will see you in the next week.